Could you take your seats? At this point, I'd just like to remind everyone of a few housekeeping points. Can I ask that you put your mobile phones on mute silent during the conference out of respect for our speakers, and take important phone calls outside the ballroom. You can see there's also a feedback form on each of your tables. Please take some time to fill this in at the end of the session and leave it on the table. Thank you. Good morning again, and a very warm welcome to Tokyo and the Fidelity Investment Leadership Conference. My name is Gareth Nicholson, and I will be your host for the next 1.5 days. To get our event underway, I'd like to invite Mr. Mark Talbot, Managing Director of Fidelity Worldwide for Asia Pacific ex-Japan, to the stage to give us the opening address. Mark, please.
Good morning, ladies and gentlemen. I'd like to extend a very warm welcome to Tokyo and the Fidelity Investment Leadership Conference. It's good to see so many of you here, and thank you all for joining us at this week. This event has now become an established fixture in the calendar and is proving to be a useful platform to exchange views with our valued clients and distributors, as well as share our insights into cyclical and secular trends shaping the investment landscape. Fidelity pursues an active investment style based on comprehensive bottom-up research. You won't hear a house view from Fidelity because we welcome a diversity of opinion. We invest with conviction based on fundamental bottom-up analysis, not headline news or noise inherent in economic data. This approach is supported by having one of the biggest on-the-ground investment teams of any asset manager, with over 400 investment professionals located across the globe. To give a flavor of some of the themes we'll be exploring in the next 2 days, 2013 has been dominated by uncertainty over when the US Federal Reserve will begin to scale back its unprecedented policy of quantitative easing. Our panel of experts will have a lively debate on this topic later and assess the implications for each of the major asset classes. Without wishing to steal their thunder, I think the important question for investors to ponder is the potential inflationary consequences if the US Fed keeps policy too loose for too long, by assuming that the non-inflationary growth rate is the same as it was before the financial crisis. We've been arguing for some time that prudent investors may want to hedge some of these risks. We'll be exploring at some length where the investment opportunities might lie in the next 12 months. And although it appears that volatility has fallen from the levels seen in 2012, uncertainty remains. Some investors are seeking growth, but many are still searching for income, driven by low deposit rates. A clear feature of the past 12 months has been the outperformance of developed markets, including Japan, relative to emerging markets. There's been a great deal of excitement and debate generated by Abe's Three Arrows reform program, and we'll be hearing more about this topic later from our distinguished guest. One of the key points we've been stressing on Japan is that uncertainty offers opportunities, and investors need to form a balanced view on the prospects for real change and not act purely on the recent past. We've also been advocating for some time now that investors need to reappraise the US market in light of a stronger US dollar, new drivers such as shale gas, and progress on underlying deficit and debt issues. Lower energy costs and technology like 3D printing could revolutionize the prospects for US manufacturing over the longer term and reverse some of the advantages that China has enjoyed in the past decade. With regards to China itself, there is a clear need to change from investment-led growth to growth led by domestic consumption that will require a complex series of reforms to happen with respect to state-owned enterprises, social security, and local government. On the other hand, while the challenge in China is overinvestment, a key challenge for the rest of emerging Asia is to sustain levels of investments to continue to build out infrastructure and maintain robust growth rates. Although emerging markets came under pressure in the third quarter, linked to the prospect of Fed tapering, we do not envisage the situation will be comparable to the Asian crisis of 1997. The big difference between the past and the present is that Asia has learned to be more self-sufficient, less dependent on the West, and crucially, Asia's economies are not as exposed to foreign debt as they were in the late 1990s, because they developed deeper local currency debt markets, accumulated vast foreign exchange reserves, and have more flexible foreign exchange rate regimes. As such, we've taken a view for some time that investors need to be more selective in emerging markets in terms of assessing the progress on structural reforms and the impact on market outcomes. We believe that those countries that are bold with reform will be likely to outperform, while those that avoid difficult decisions will likely lag behind. While this has been an equity-driven year, allocation to bonds continues to be important, both from a diversification and an income point of view. And while bonds seem to be the obvious choice when thinking about income, I strongly believe that investors should not forget about equity income. Over the long run, compounding dividends is a powerful driver of total returns in equities. In the current momentum-driven markets where cycles have shortened considerably, I don't think it's easy to strike the right balance between income and growth assets in a portfolio. Hopefully our panel discussion, The Age of Income, will provide some thought-provoking ideas around this. So once again, I hope you enjoy the conference. Thank you for your participation, and I look forward to speaking to many of you in person over the course of the next 2 days. Thank you.
Thank you, Mark. Our next speaker is Mr. Yasuhisa Shiozaki. Mr. Shiozaki is currently the Director of the Committee on Budget in the House of Representatives and also the acting chairman in the Policy Council of the Liberal Democratic Party. He is a successful politician here in Japan and has held various roles in the Japanese Diet, both in the House of Councillors and House of Representatives. Mr. Shiozaki will share with us some insights on Japan's current economic policies under Shinzo Abe Prime Minister, or Abenomics as it's commonly known. After Mr. Shiozaki's speech, there will be a question and answer session hosted by Alex Treves, Fidelity's Head of Equities for Japan. Mr. Shiozaki, please.
Good morning, ladies and gentlemen, and I'm very pleased to be invited to speak this morning at the meeting on Fidelities, and I think the participants are all well, from the every corner of the world, I guess, but mainly from Asia, I understand. And I'm especially pleased to observe such a big shift of investors' interest back to Japan from the days of Japan passing to the days of 3 arrows of Abenomics. But your interests have not perhaps turned into confidence yet. So today, I am limited, well, in my limited time, I would like to clarify the developments of changes in Japanese economy that have occurred since the last autumn when Prime Minister, Mr. Abe became the president again of the LDP, and what is the pipeline, what is in the pipeline, and what challenges lie ahead. Since the introduction of Abenomics, the Japanese economy has been observing improvements in financial markets, the real economy, the corporate sector, and households. Stock prices are on an uptrend. Real GDP has registered relatively high growth for 2 consecutive quarters since the turn of the year. Business fixed investment has been picking up, and employee income has been increasing. As you are aware, Abenomics is comprised of 3 arrows. The first arrow of bold monetary easing has changed people's expectations and heightened their motivation to invest. This is in sharp contrast with the period up to Mr. Abe's election as the president of the Liberal LDP last autumn, during which time people widely felt a strong sense of stagnation. The second arrow of flexible fiscal policy has led to the formulation of 10 trillion yen supplementary budget, the first large-scale budget in quite a while, and was sufficient to change the mindset of the market participants. The third arrow of the growth strategy aims at changing the structure of the Japanese economy through a wide range of policy measures. In an unusually early tax debate in LDP this autumn, the business fixed investment tax cut and an R&D tax cut have been determined in advance, and in the present session of the Diet, there has been discussion over legislations to implement a growth strategy such as the Industrial Competitiveness Enhancement Act and the National Strategic Special Zones Act. As clarified in the third arrow of the growth strategy, This policy package is not a complete version, but is to be augmented and revised. The government's and LDP's headquarters for Japan's economic revitalization will be maintained, and the Industrial Competitiveness Council, the Regulatory Reform Council, and the Council on Economic and Fiscal Policy are focusing on additional regulatory reforms and economic measures toward revitalization of the Japanese economy. A revision of the growth strategy is scheduled for around June of next year, and both the government and the LDP are working to that end. More than 20 years have passed since the bursting of the bubble, and the Japanese economy has been mired in deflation for nearly 15 years. During this long period, we have to admit that we have not responded sufficiently to an increasingly globalized and borderless world economy and to the demographic changes of a very low birth rate, an aging and a declining population. Therefore, the problems the current Japanese economy is facing cannot be solved overnight. The issues Abenomics has to tackle and solve are wide-ranging. They include reforms not only for the structure of the Japanese economy, industries, and society, but of more deep-rooted values such as the culture, nature, and climate of the Japanese economy and society. They also include reforms that do not directly relate to the economy, such as a reform of governance in universities. Of course, the needed adjustment of the domestic industrial structure associated with TPP are also going to be profound. As the wording, Japan's lost 2 decades suggests, we need to accept that it will take considerable time to resolve problems that have built up over a long period. Having said that, what is important is how quickly we must resolve these problems. As Prime Minister Abe stated in his policy speech in autumn session, our only alternative is to proceed without hesitation down the road we have chosen, which indicates that we have no choice but to move forward, even if it is difficult or in the face of strong resistance. Let me give you one example of such cases when we, from ruling party side, had to intervene in the process of formulating the bill for the National Strategic Special Zones. In the process of preparing the bill in the government, despite the fact that the content of regulatory reforms was still at a preliminary stage, resistance from regulatory ministries, as well as industries concerned, was quite fierce. The content of the bill eventually became in line with the concept laid out by the private sector members of the Industrial Competitiveness Council, but only after the LDP's intervention in the government's bill formulation process. As seen from this example, our road ahead will surely be a bumpy one. Nevertheless, we must fervently continue to move forward. In May, 1 month prior to the government's growth strategy, the LDP published its interim proposals, namely the LDP version of growth strategy. While many of the proposals were incorporated in the government's growth strategy, there are some important policies that were not officially taken up in the government's policy package, but have been proposed as complementary measures based on an agreement with each ministry concerned, and that have gradually been put into effect. In particular, the LDP is tackling important medium to long-term challenges that relate to the culture, nature, and climate of the Japanese economy and society. The greatest mission of Abenomics is to take the intrinsic potential of Japan and the Japanese people and aim toward the revival of strong Japan. In other words, improve the economy's metabolism and regenerate a healthy and active Japan. Why has the Japanese economy been stagnant for such a protracted period and lost its competitiveness? Why has Japan, which in the past marked high growth rate while enjoying high profitability and high productivity, tumbled into a situation of being labeled as having had a lost decade or two, and of suffering from a sense of strong stagnation? Such questions lead us to consider the importance of metabolism in the economy. There are several intrinsic questions that need to be answered. Why is that in Japan, companies that lost competitiveness and have low profitability and low productivity have yet been able to survive as they are? Why in Japan are both new business startups and old business exits quite stagnant? By contrast, why is it that rapidly growing companies, examples of which we see overseas, especially in the United States, Microsoft and Apple and Google and Facebook and so on, do not emerge in Japan? Giving answers to these questions is the mission of Abenomics. One answer may be that there were plenty of stumbling blocks that hampered Japan from realizing its potential. If that is the case, we have no choice but to remove them one by one and re-establish an environment in which Japan will be able to exert its potential again. We have already set another agenda and have been in the process of working together with our government to remove these stumbling blocks. In that regard, Prime Minister declared in his speech at the New York Stock Exchange in September that he would like to turn Japan into an entrepreneurial powerhouse, and suggested that the government will put emphasis on nurturing venture businesses. This is an important change. Promotion of new startups is promotion of employment, and it is also an important policy challenges for labor mobilization. To realize its potential, the government's involvement in the private economy needs to be reduced. First, regulatory reform is required. Our Prime Minister declared that regulatory reform is the centerpiece of Abenomics, and we are now in the process of constant regulatory reform while also putting emphasis in the areas such as agriculture, medical services, and labor policy areas that have not been addressed sufficiently in the first package. Of these, agriculture is bound to go through drastic reform in the coming years because of the TPP. The National Strategic Special Zones are places in which to experiment with such regulatory reform. We must make a breakthrough back to competitive Japan again, and although this takes energy, we must carry it out. Japan is a country of indirect finance, meaning banking, and quality and nature of the economy and industries are often determined by banks' lending policy. Procrastination with regard to troubled companies' problems has been a prevailing issue concerning banks and was one of the major reasons for the Japanese economy's low metabolism, as seen in the survival of zombie companies. In May, The LDP agreed with FSA upon encouraging a shift in banks' lending policy toward more emphasis on workout and restructuring as well as new business startups. Eventually, the FSA drastically revised the financial monitoring policy in September and is steadily making efforts to change banks' strategic management and lending policy. The FSA stands to back up corporate restructuring and business creation and startups has become increasingly clear. Japan Airlines bailout implemented by former government made it clear that without explicit principles based on consistent competition policy, in the case of government bailout, market conditions for competition would be distorted. For the purpose of shifting government's old-style discretionary industry policy to more transparent competition policy, we submitted a bill to the Diet last Friday to secure a level playing field, preparing for the possible future government bailout case of private companies. The draft bill requires the Fair Trade Commission to establish a guideline the government should comply with and to issue a reminder when there is an off-the-guideline assistance to government that adversely affect the fair competition. It is crucially important for Japanese companies to have better corporate governance. In order to have companies that can discipline themselves and exert fairness, as well as high productivity, high profitability, and high capital efficiency, corporate governance is vital. In this regard, government is planning to submit a draft bill that is supposed to further encourage companies to introduce independent directors on the board of directors. And we, from the part of our ruling party, have to make sure the proposed bill is effective enough. In addition, to resolve the cross-shareholding structure, which hampers the effective functioning of corporate governance, and to address shareholdings by banks, which tend to behave as silent shareholders, I think it is preferable to reduce or even prohibit the shareholdings by banks for better governance of borrowers. Furthermore, in order for institutional investors such as insurance companies and pension funds to become capable of influencing companies through active and sound dialogue, as well as possible execution of shareholders' rights, the FSA is working on the Japanese version of Stewardship Code, and proposals will be coming out soon by the end of this year. Due partly to the request from us, the LDP, a meeting of a panel of experts has been established within the government, and a new asset management policy through diversified investment by government funds, notably government pension investment funds, GPIF, and more effective governance system of GPIF have been discussed, and the final proposals will be announced by the end of this month. If the government fund sized at 110 trillion yen can bring about improvement in profitability upon being involved more actively in private companies' management policy, the ensuring effects on those companies' growth should be significant. Policies comparable to all these reform policies have been boldly experimented in Germany in the early 2000s. Germany, once called a sick economy of Europe, is now a locomotive of EU economy. It was Chancellor Schroeder of SPD who brought the drastic change. Next month in Tokyo, we are inviting Mr. Schroeder to a panel discussion. We should like to know how his government carried out reforms that brought pain to the power base of the government through labor policy reform, social security reform, and corporate governance reform, financial and capital market reforms, which eventually brought about economic revival of Germany. Mr. Schroeder resolved the cross-shareholdings by abolishing capital gains tax, thus enhancing the functioning of corporate governance. He also promoted a prepackaged type of resolution and instituting labor law reform to facilitate labor mobility. It is often said that current Chancellor Merkel has been benefiting from the fruits of the painful reforms carried out by Mr. Schroeder. Now that time is running out, let me conclude my remarks by laying out some more challenges that face us. Through various reforms, we are now projecting our potential growth rate, which is now as low as about 0.7%, going up towards 2% by 2020. In order to achieve that goal, and given the declining population, we will have to contemplate the possibility of accepting more foreign workforces in near future with high quality and high technological expertise. Besides, of course, encouragement of labor participation of female and elderly, and of course, a drastic productivity growth. Achieving high productivity growth, especially in the non-manufacturing sector, is another big homework. Attracting the best human resources from all around the world is a prerequisite for a growing economy. Reform in education and R&D environment, including governance reform of universities, is crucially important for a more innovative, high-value-added society. We are hoping to see at least 10 universities among the best 100 in 10 years from only 2 universities today. Of course, fiscal consolidation must be addressed, but we have to make sure that an economic growth is the most important prerequisite for meeting the government's target of having primary deficits by 2015 and achieving primary surplus by 2020. It is also critical to curtail social security costs and to streamline government spending. In this sense, I would propose for Abe administrative reform following Hashimoto administrative reform to minimize the tax burden of general public. What is important is not an organizational reshuffling, but a redefinition of government itself. Developments under Abenomics have been encouraging so far, but there is no room for complacency. We are well aware of the challenges that lie ahead of us, and we are committed to revitalize the Japanese economy. Such delivery is what the public expects from us, the lawmakers, and thus it is our responsibility to accomplish needed reforms. Thank you very much.
Thank you, Mr. Shiozaki, for that fascinating insight into policy reform. Could you please take a seat? And can I invite Alex on stage, who will be hosting a Q&A session with Mr. Shiozaki. And just a quick note, there will be some reading materials related to Mr. Shiozaki's speech distributed later. Thank you.
Well, Shiozaki-sama, that was excellent. Thank you very much. Highly encouraging. But of course, we have some questions about execution and the viability of everything that you have laid out. I will ask the first couple of questions, and I will open them up to the floor. So the first question is around immigration, which you mentioned. You referred to the fact that partly because of Japan's demographic challenges, it might be a good idea to bring in highly qualified labor some high-end immigration to bolster the economy. However, there are other areas of the economy where perhaps lower-end labor would be more welcome, such as given the reconstruction in Tohoku and the work necessary for the Olympics. There's clearly a squeeze on construction workers at the moment. And also, given the aging population, there's a strong need for more nursing care and medical staff to come in Japan. However, we've observed that there's some resistance, maybe some cultural resistance to having lower-end labor come into Japan. What are your thoughts on that, please?
We try not to use the word immigration, but instead we hope to use the word, as I used in the speech, the foreign labor forces or workforces. And it is true that in some parts of labor markets, there are shortage of workers already, especially taking into account the great need coming from Tohoku, where the devastating damage was caused by earthquake and tsunami. And also, as you correctly pointed out, we're going to expect Tokyo Olympic in 2020, and probably, well, it's 7 years ahead, but I guess construction process should be completed in 5 years. That means we are going to have more tight labor market for construction and rather low-end labor forces. And already the wages for those construction workers has went up to extraordinary level already. So I guess, well, we do have a basic policy of inviting high upper-end labor forces from abroad, but so far it's not, well, we're not observing good results yet, partly because there aren't so many places where lots of able, capable people from abroad like to work, or especially like universities. That's why we are now trying to change universities to become a place where many people can come to Japan. But at the same time, we have a training programs for 3 years for the, well, closer to low-end market. And I guess we are trying to increase the closer to low-end labor forces in an orderly manner by improving the system for trainees that we have now. And the discussion is now taking place in our party. We just had one meeting last week, mainly, well, I am the one who is now leading this discussion. And I guess by next spring, a new scheme will be coming out, or improvements of present scheme is going to be coming out. And we are hoping that labor market won't be so skewedly tight, you know, in future.
Thank you. Now, I completely agree with you that Japan needs inflation, but not all inflation is good inflation. And there is the risk, of course, that CPI rises in the absence of wage increases, and the consumers that we need to help revitalize the economy actually see their spending power squeezed rather than expanding. I noticed a sort of maybe a paradox in your speech, that you said that the government should become less involved in the private sector, but equally the government needs to encourage the private sector to increase wages to prevent this bad inflation. How will that work out, and what are the prospects of success from the government in getting the corporate sector to increase wages?
So far, our government, especially Prime Minister Abe, has been voluntarily encouraging companies to raise wages. well, if you like to call it an intervention, government intervention, it is, but it's not illegal or whatever, forceful intervention. Just asking them to raise wages. But ultimately, profit must be made for companies to voluntarily raise their wages. So I think what is important is going back to the basics to improve the conditions or environment where companies will operate. And that means deregulation and maybe tax treatment of many items should be taken care of. And also corporate governance, again, is probably the key for companies to be more productive, and maybe realignment of industries with too many companies in one industry. And all those brings about the low wage, low profit, and fierce competition without any satisfaction. And that's been, again, conducted or kind of helped by the procrastination policy of banks, of leaving the situation where fierce competition without profit allowed. So all these policies altogether, although it takes time, but we cannot solve problems so easily, and no magic won't be helping us anyway.
Thank you. Now, I have other questions, but it would be selfish of me to monopolize your time. So are there any questions from the floor, please? No? Well, that's great news for me. Oh, Matthew.
I wonder if you could expand a little on TPP, because that's going to be another very challenging area, particularly if the intention is to reduce tariffs to zero on the protected kind of core food groups like rice, etc. Is there really the appetite to push that through with the farming lobby being as strong as it is in Japan? Could you just talk a little bit about how that might play out, do you think?
As for the agriculture, I guess, power balance between agricultural cooperatives and politics or the government has totally changed. And the initiative is on the hand of Prime Minister Abe. And now, which I think is very good, the people in agriculture and also people involved in agricultural policy in politics, and also agricultural Ministry of Agriculture, the mindset has quite changed and becoming more and more positive and constructive. And I think probably this is the first time ever to think positively what to do with the weak agriculture and how we can make it more competitive. And so I'm not so pessimistic about the future course of policy-making process, although there are, of course, yells and all that cries, but I think we can make it.
We have time for one more question. Anyone else on the floor?
Hi. Typically, I think when there are conflicts across cross-borders, most financial markets will take notice. But I noticed in recent times with the tensions with China, the whole financial markets have not reacted at all. I just want to hear from your perspective, is this something in the agenda of the government? And I don't know, is there any possibility of this catastrophe happening at all?
I think so far, politics is not working in China-Japan bilateral relationship. But at least growing number of Chinese, especially in local governments and local communities, observing the values of better economic relationship between China and Japan. And without Japanese investment in China, especially in local communities, I think local economy won't be working well. And because Japanese investment is pretty much, much stable than other countries' investment. And although the tension, political tension is high, the local governments are sending more people to Japan to have roadshow or something like that to invite Japanese investment. And I think unnatural phenomenon won't last forever. And I think there will be a tipping point where things are going in a better course.
That was an extremely elegant answer. Thank you, sir. Now, you're a very busy man, so I think we need to leave you to the rest of the day to go and fix Japan. Will the audience please join me in giving a round of applause for Shiozaki-sama? Thank you.
Yes, thank you, Mr. Shiozaki, and thank you, Alex. Okay, moving away from Japan now, let us turn to a topic that is also being followed extremely closely by the markets: tapering of the US Federal Reserve's quantitative easing program. It's been about 5 years since the Fed initiated this unconventional monetary policy. Around the middle of this year, the Fed hinted it may scale back some of its asset purchases, based largely upon improvements in the US labor market. However, the widely expected move to taper has not yet materialized. So when will the Fed initiate its first taper, and how will markets react when it happens? Let's get some insight into this topic from Fidelity's panel of experts. So first, I'd like to invite Tim Orchard, Head of Equities for Asia ex-Japan at Fidelity, and the rest of the panel members on stage to discuss. Thank you.
Thanks, Gareth. Okay, so we're here to talk about quantitative easing. And what we've done, we've assembled a panel, as Gareth said, of experts here who collectively, I calculated, have 75 years of investment experience between them. So hopefully we can add something to this debate. I'll just introduce them very briefly and remind you that 4 biographies are in your packs that you have in front of them. So Miguel Corte-Riel on my far left is Investment Director for Europe. Eric Wong here is a fixed income portfolio manager for us. James Bateman to my right here is Head of Multi-Manager and Multi-Asset Portfolio Management. And last but by no means least, Mr. Matthew Sutherland on my far right is our Asian Head of Product. So quantitative easing is a slightly curious concept in many respects. Let's just briefly go back to the financial crisis, when we had a situation where central banks were essentially fulfilling what I would term their traditional role, which is acting as a lender of last resort. But this quickly segued into this concept of quantitative easing and the idea of asset purchases. And the US is still running at about $80 billion per month. Now, the reason for this was fairly obvious. For better or worse, the Fed wanted to avoid the kind of socio-economic collapse that we saw in the 1930s. So that was the last time that we saw a credit-fueled bust of this magnitude, with fairly disastrous consequences for both the nominal level of GDP and the general price level. So my first question, I guess, before we get on to tapering, I think we need to talk about the efficacy of quantitative easing, because there is a debate here as well. There are those that argue that it's actually been not a great policy, that it's led to a bloated economy, to one where returns will be lower by definition, and therefore we would be better off in seeing a general clearing of the economy, which we haven't seen. So maybe we've gone to more of a Japan-style set of economic policies. The alternative view is clearly that this has stopped Armageddon from developing, and we're all better off because of it. But I think before we talk about what happens when we taper, we need to think about the efficacy of the policy overall. James, maybe you can sort of start off more from a global perspective on that. How do you see quantitative easing, and it's, has it been effective?
Sure, thank you. I guess I'd begin by saying, the difficulty in assessing any macroeconomic policy is we never have a counterfactual. We never know what would have happened if something hadn't been done. So if we say that the purpose of QE and US policy in general was to avert a 1929 onward scenario of a Great Depression, box ticked, it happened. What we don't know is fundamentally whether that was the result of QE and other policies, or despite it. So we don't know, but I think our view would be in aggregate, Fed policy and US government policy has been the right thing to do. We've consistently said within the solutions group that US actions have been supportive of creating a recovery situation. That said, clearly there are drawbacks of that. And the way we'd characterize US government policy is much like a parent trying to teach a child to ride a bicycle. The idea that they might fit stabilizers to that bicycle to stop the child falling off and crashing, and that's effectively what the Fed has done with the US economy. But as every parent knows, that there is a time when you need to let that child ride free without those stabilizers, because if you keep sort of holding on too tight, keep trying to manage things, keep trying to look after that child, protect that child too much, that child being the US economy and the global economy here, that's not a good thing for that child's development and for the economy's development. So we think QE had a place, we think it did its job, but we also believe very strongly that there is a time to move away from that sort of policy and let the world economy and the US economy sort of ride free without direct government intervention.
Okay, we'll find out whether the bicycle falls over in a minute. Just from a fixed income perspective, Eric, how do you see things?
Yeah, I think with QE, it's important to look at it not from just one angle, but necessarily from a bunch of different viewpoints. So in fixed income, what we like to do is look at it from both a benefits and a cost perspective. From a benefits perspective, I think it's a chapter in the QE book that is more fleshed out. I think if you look at the US data, however it got there, the fact is manufacturing is rebounding. You're seeing improvement in labor market, and most recently we're seeing a broad-based pickup. But I think the more interesting question is the cost side, and I think that chapter is still being fleshed out. Obviously, there are concerns about inflation, and I think that is a right, if nothing else, academic concern. But I think what the market does not necessarily appreciate is the communications aspect. Obviously, policymakers in the US have gone into uncharted territory in policymaking, and how they're able to take us out of that territory back into a more normal landscape is the key. Of course, that is intimately connected to the inflation picture. But bottom line, if there's going to be a book on the history of QE, I do think factually at the moment, the chapter on benefits is more fleshed out, but the chapter on costs is still being drawn.
That's a very good point. We are in the midst, I should remind people, of a huge experiment in global monetary policy, and we actually don't know what's going to happen, and that's why we're having this session. Miguel, just from a European perspective, slightly different situation in Europe.
Yeah, actually in Europe we had the benefit of not having the QE. We had the LTRO, which is in a way a different form of QE. I guess it goes back to the different areas of the world of where you can accept or not this type of policies, more interventionist or less interventionist by the governments. I think culturally in the US is probably more acceptable, while in Europe probably less. And so taking the measures that have been implemented in terms of the US and being very active and from the Fed is very different from the ECB. And the fact that the ECB was vocal and mentioned some that would be available to do that kind of QE, which is part of a silent QE. So time will tell us which way is more successful in terms of QE, in terms of implementation. But so far what we've seen in terms of results and restructuring and the points that actually the guest speaker made in terms of restructuring the economies and turning the economies more competitive, we start seeing the signs in Europe of that. So we may be, for Europe, the fact that we didn't actually use the QE was a successful way of basically re-engineering and reconstructing and reinvigorating the economy again, as the example in terms of Germany. So I guess time will tell us, which way will be more successful.
And Matthew, Asia, looking on.
Well, I suppose my comments are not specifically Asian per se, because the question is a global one, right? I mean, my feeling is that it's a bit like democracy. It's, quantitative easing is the least bad thing you can do in the set of circumstances, that we were in back in 2008, 2009. So as James points out, we don't know what would have happened if we didn't do it, but, I think it's essential that we tried it, and I wouldn't have wanted to have gone down the experimental road of not doing it. As for whether it works or not, I mean, I think we all know it's a bit like pushing on a piece of string. So it works, I think, in that, in a way, it buys the world time to go through the deleveraging process, which is what at least the US has gone substantially down that road. Europe, I think, less so. But it buys you time to do that. What it doesn't do is get the world back to work. So it doesn't get the labor force up, it doesn't improve employment, and it certainly doesn't generate CPI inflation. It generates asset price inflation, but not CPI inflation. And that's because every dollar the Fed prints effectively goes to somebody who then gives it back to the Fed or puts it in the bank or hopefully perhaps buys a Fidelity mutual fund with it or something like that. So it goes back into the savings pool and helps people and corporates and countries de-lever. But it doesn't go to the supermarket and buy oranges and apples and generate CPI inflation. So I think it works in that it probably helped save the world from a 30s repetition, but it doesn't work in terms of getting employment and CPI up.
Although you could argue that effectively what is being done is to underwrite a certain level of positive nominal GDP, then the idea being that feeds into confidence and capex, et cetera. So, but as you say, it is counterfactual to some extent.
And the wealth effect as well. So one can't underestimate the wealth effect in stimulating the economy and giving at least a portion of the population the confidence to spend some money.
Okay, so we think it is important. Now we move on to tapering. We had a scare in May. James, what's your feeling about the future of tapering? When's it coming? What do you think the effects are going to be? And from your perspective, could that possibly be a positive?
Sure. I think, the obvious answer is we don't know when tapering will come. What we do know is we are going to see it in the relatively near future, so that probably being H1 next year. And actually, we probably shouldn't get overly fixated on precisely when that date's going to be. One of the risks in financial markets with all of us staring at daily data and, in fact, minute by minute, second by second data is we forget that sometimes the exact timing of something isn't that critical. There will be an inflection point in markets when you see a big announcement around tapering, inevitably, but it will be a short-term panic reaction. So we would anticipate a short sell-off in risk assets at the point at which tapering really starts, or at least is seriously discussed. But actually, fundamentally, we see tapering as good for risk assets, because what you're going to see in equities is a return to fundamental investing. We're going from a situation where you're effectively creating a rising C through QE to something where fundamentally what's going to drive markets is what should and always has driven markets, and not government intervention. We also think QE is a very, the end of QE and tapering is a very good thing, because if you actually think about what it's doing, we've already talked about the fact that it's enabled deleveraging, but actually it's also enabled leveraging, and you've seen this emergence of increasing shadow banking organizations taking advantage of easy monetary policy in the US and elsewhere recently to increase loans to risky counterparties to places that traditional financial institutions don't want. And therefore, actually, if QE continues and easy monetary policy continues for too long, what you will see is a return to the conditions that partly created the 2008 financial crisis. So turning it off is actually very, very important for the long-term health of the global economy.
And do you think that they can get that timing right?
Well, no one will tell them they got it right at the time. There will be a bad reaction whenever they do it.
We're talking about central bankers here. So
yes, I mean, exactly. I mean,
should we have that confidence?
Well, no, I would more say the market will never believe central bankers have got anything right. I think that's just an inherent part of being a market participant. We all think we could do it better. We couldn't in reality. That's just part of the nature of working in finance. However, I do have a reasonable confidence that the broad brush timing of some point next year and probably in the first half is the right thing to do, and that's likely to be when they do it. So yes, I mean, I'm not concerned in that respect.
Derek, maybe bring you in at this stage. I know you've got fairly strong views on this.
Sure. I actually agree with James. I think long-term, the tapering will be a good thing. Obviously, in fixed income, short-term, we've seen some struggle, but if I draw it to an analogy, it's obviously QE, the tide that lifts all boats. A few years, it's been pretty high. Question is what happens when that tide recedes. And here's where I do think that we can be very constructive on the outlook on a long-term basis. The reason is twofold. It's about what central banks do, and it's also about what government policymakers do. And I can provide some concrete examples. When you think about what happened in Malaysia the last couple of months, they've passed some, I think, fairly meaningful fiscal reform. They passed what's called a goods and service tax, GST, and is taking a step closer to getting their fiscal situation in order. When you look at Indonesia, yesterday the central bank hiked interest rates in spite of expectations to keep things the same, and that was a very strong affirmation of their commitment now to be proactive and not necessarily reactive. In both examples of Malaysia and Indonesia, we're seeing policymakers take the right step, whether it's, again, structural reform or policy-making action on a monetary basis. And I think that speaks volumes about the true reason for investing in fixed income markets like emerging markets and also like Asia. It's about unlocking that potential. So I do think that, unfortunately, even though short-term it will be painful, long-term it will be a good thing because the tapering of QE and the normalization of policy will be the catalyst that compels policymakers to do the right thing.
Miguel, just from a European perspective, does this actually matter?
No, it actually does matter because if you look at the correlation between the U.S. market, U.S. equities and European equities is pretty strong for the last 100 years or more. So whatever happens in the U.S., obviously, will have a positive or negative reaction in terms of what's happened in the European markets. But going back, and I couldn't agree more with our view, which is by the end of the QE, it's because the Fed will think that the economy is getting stronger, and by that, that's actually a good sign for equity market. And I think we can actually have an end of QE with a continuation of low interest rates, which will benefit the economy as an overall. In terms of Europe, what we will not see is inflation picking up, because we continue to see labor being still, actually a lot of unemployment, which actually doesn't put any pressure in terms of inflation and in terms of real wages growth. So in a sense, if you go back, the end of it being first quarter, second quarter, I think will be perceived maybe initially with a reaction by the market, either up or down, depending of the views and the consensus, but on the medium long term as a positive sign that things are getting normalized. And from an equity perspective, that is actually positive, because then we can go back, as James was mentioning, back to the fundamentals and actually differentiating between a good company and a bad company in terms of valuations, which is actually good for us in terms of stock picking.
Okay, thanks. And Matthew, just the general issue of tapering, and also the impact on Asia. And it's, when we had a dress rehearsal, I suppose, in May, it wasn't great for the Asian markets. So how would you see things going forward?
Well, on the question of timing, I'm hoping that we shouldn't be trying to predict the timing, because the timing should be dictated by the state of the global economy, and one would hope that that's what will guide the Fed. And I'm a little bit worried, personally speaking, that the Fed have boxed themselves into a corner with their forward guidance, because they're tying themselves to two indicators, basically employment and inflation, in an economy, and we all know that economies are chaotic systems, and there are more things at work than just two indicators. So there's a danger, I think, that being driven by two indicators will cause them to remove or to start to taper too soon. And whilst I accept the arguments of my colleagues that it'll be healthy, I think there's a grave danger of it being done too soon. And to James's analogy of the child on the bicycle, take the stabilizers off by all means, but do so when you've got a reasonably decent chance that the child won't fall on its head, right? You don't really want the child to fall on its head. And I think that because the recovery so far is relatively jobless, and there's still no CPI inflation in the system, because the velocity of money is still falling away, personally, I hope they do it later rather than sooner, because I wouldn't want the baby to fall on its head. Yeah.
So this risk of inflation that Mark was talking about in his introductory speech, you just think that's...
You see, I'm in the opposite camp, and I mean, that's what makes markets, isn't it? But I mean, I still think there's a grave risk of deflation. I think the deleveraging process is a highly deflationary process, and I don't think we're through it yet. I think we're partially through it in the US. Don't think we've really started the process in Europe, and I'm not quite sure that we need to do it really in Asia. But I think the deleveraging process has a way to run yet, and it's highly deflationary. And if you take the stabilizers off too soon, as Japan learned, in a previous cycle, you can stall the whole thing, and that would be tragic, I think, for everybody. So that's my major concern would be that we do it too soon and stall the global economy.
Okay. Yes, we don't have a house view, which I think has been made perfectly clear. Okay, we're going to put you guys on the spot now. So we've discussed QE, we've discussed tapering. In terms of sort of positioning and how you would actually set things up into this environment, James, you talked about this could be good news in the sense that active management could work a lot better than it might do today, with risk on, risk off, and the macro variables there. So what would you be looking to do into this tapering scenario?
Thanks. I think the answer is twofold. So a medium-term view is that tapering is going to be good for fundamental investing, as I said, and therefore active managers who take high conviction picks in a limited number of stocks are likely to outperform. So wherever you're investing, we think the next 5 to 10 years will be characterized very differently from the last 5, where actually it's picking the right stocks, not making the right macro calls that will really drive markets. Now, from my perspective, that's great, because I have a team of people paid to pick good fund managers, and as a house, Fidelity obviously is an active fund house, but we do think this will be a good thing for active fund management in general. And within that, where are we biased at the moment? We're very comfortable investing in the US and US equities in particular, and high conviction US equity plays in strong fund managers are somewhere we feel very comfortable. Coming back to the shorter term though, we believe and I believe that at the turning point of tapering becoming a reality, you'll see a short-term risk asset sell-off. You either therefore want to be in lower beta equities for the time being, gradually rotating into maybe a neutral beta portfolio, or you want to just lower your equity weight and as we've done, maintain a good amount of cash ready for additional equity investing post the sort of tapering announcement and start of a serious tapering policy. The one thing I would add, though, is we need to distinguish in all of these discussions between the start of tapering and the end of a fully accommodative, easy monetary policy, which is probably some years out. We've got record low interest rates, all these other things that are massively stimulating for the economy. We're a long way off a normal economic policy, and therefore we actually have a long period in which we will still have conditions that are conducive to a stimulating economic growth and economic recovery. It's just that they might be slightly less accommodative than they were once tapering starts.
So it's about the rate of change, effectively, rather than an outright accommodative policy. Okay, thanks, James. Eric, you have a particularly difficult job in this environment, so what will you be doing?
Well, I think for me, I guess I would break it down into both a top-down and a bottoms-up view. I think in terms of top-down, from my point of view as a fixed income portfolio manager, questions such as duration positioning, do we expect yields to go up or go down? Spread positioning, do we expect credit to outperform or underperform, are the key questions. But the way I look at it, particularly for a 2014 outlook, is I probably would like to be more neutral than not. And the reason is simply because what the Fed's done and policymakers have done by extension around the world is introduced a huge amount of uncertainty. And that volatility means the risk-adjusted return outlook for these high-level bets, it's actually pretty low in my opinion. A lot of people are talking about the start of tapering, and I think that's a good question. But I don't think a lot of people recognize when tapering starts, it's just going to be the first of many key questions. Once we get through this hurdle, investors are going to jump on when's the next amount of tapering, how much, and how that evolves. And so to me, that uncertainty, which rightly or wrongly, intentionally or not, introduced by policymakers, it's going to be here to stay. And so from a macro top-down perspective, risk-adjusted return seems to be pretty low on a forecast basis. Thus, I would probably remain fairly neutral. I think the key, however, at Fidelity is the other side of portfolio construction, the bottoms up. And I think that's where I do feel very comfortable in 2014 in hopefully making the right selection across the different fixed income asset classes. I can maybe go through really quick examples. In terms of currency, something like the Philippine peso seems to still have that structural story intact. There might be central bank intervention in the short term, but we believe that currency is poised to do better. In terms of rates, everyone's been pretty bearish on Indonesia for months now. But again, going back to recent policy action, it seems the policymakers have turned a new leaf, and I think there is an incredible amount of credibility there that wasn't there in the past. So being long Indonesia rates could be a good example on the rate side. Finally, corporate credit. I think this is key, especially with, I believe, the largest team of buy-side credit analysts in Hong Kong. We feel that even though the currency stories could play out and tapering could play out, there are credits that we can buy, companies in particular, that we feel can weather this pending challenge much better than others. And so those are the ones that we would focus on as well.
Okay, great. Thanks, Eric. Miguel, just you made the observation that this matters for Europe. What's your feeling in terms of portfolio positioning coming into this?
Yeah, I mean, it's interesting. I mean, as Mark was talking about the income, we've seen initially for about a year and a half ago, basically an increase interest in income products, dividend products, and so on. As the risk premium is basically coming down for Europe, as the restructure is coming through, we start seeing investors actually looking more into Europe than we have seen for the last 3 years. European equities, and then through European equities taking different risks. So starting with the equity income, then going into more consumer staples, and then now going more into cyclicals. Now, the market since May last year had a very good rally in terms of Europe, and the valuations have moved. We still think that from a bottom-up perspective, valuations look quite interesting. There is a self-sustained story about Europe now. And we start seeing inflows into European equities. And year to date has actually been one of the best years in terms of inflows for us, in terms of European equities. So, but we feel that might be a consolidation now here in terms of the market, in terms of European equities, and then moving on to the next phase at a later stage. So on a 12 to 18-month basis, we're quite positive, but we do feel that we need a little bit of consolidation in terms of the market.
Okay, thanks. Matthew, in Asia, a bit of nervousness around, I suspect, given what happened in May, and sort of batten down the hatches type of scenario, I would have thought.
Yeah, I mean, clearly we had a dress rehearsal, as you said, in the summer, so sort of June, July, August, where we saw strong foreign selling of most of the emerging markets in Asia, and I think that would be repeated, frankly, when talk of tapering comes back. But there's two things that caused that rotation from emerging to developed within Asia in the summer. The first was tapering talk, but it wasn't the only thing. There was a fundamental driver to that too, which is the second derivative of GDP was improving in developed markets and getting worse in the emerging markets. So the rate of GDP growth was slowing in China and many of the other emerging markets, and improving in the US, Europe, Japan, etc. So there was a fundamental reason for that as well. But anyway, I think the long and short of it is that we would expect to see further rotation from emerging to developed if we saw tapering coming back. Having said that, my colleagues have pointed out something very important, which is that correlation between asset classes, between stocks, between sectors, between countries is breaking down, which plays into our hands as a bottom-up stock picking house on the equity side, but a bottom-up securities picking house generally. So not all emerging markets are created equal. So I would say we need to be very selective in terms of countries. I would tend to avoid those with sort of stagflationary tendencies, so countries like India, for example, where you've got structurally high inflation, interest rates rising, and GDP growth slowing. And look for the flip side of that, countries like Korea, which have current account surplus, fiscal surplus, strong currency, pretty good, solid economic fundamentals. So the two countries that we really like are China and Korea for those reasons. Current account surpluses, very strong fiscal positions, strong currencies, and the cheapest markets in Asia. So both of them trading on 8.5, 9 times earnings with very good levels of earnings growth coming through. So I'd much rather be positioned in those than in the Indias and Indonesias, which are seeing these stagflationary problems.
Actually, Raymond Ma, one of our China portfolio managers, has just sat down at the back, so he'd be very glad to hear you say that. Okay, that's our half hour. So I think at this stage I'll open it up for questions from the floor, if there are any.
Thank you. Eric, in particular, question. You mentioned about not at this point in time, it's probably for the next X number of months, not the best thing to do to take inherent big risks on either side of the tails, but I would agree. However, I assume you must have some type of assumptions of, given where, if we're going to see a bit of tapering, depending on how much that would be in the next 3 to 6 months, how long interest rates are potentially going to react, and what effect this might have on the currency. Because at the end of the day, I think you just discussed, and Matthew mentioned the wealth effect, that the big overriding success from the Fed has been that they kept mortgage rates contained. That meant that the housing recovery has picked up and everything, but we don't know. We're making assumptions that maybe the short end of the yield curve stays lower for longer. I think that's a fair assumption. We don't know how the long end is going to react, which could potentially unravel some of the good things that we've seen. So maybe can you just give me an idea of how you're kind of looking at the currency perspective, first of all, how the dollar might react, but also how the long end of the yield curve might react. Do we expect it to be steeper for longer, or?
Yeah, those are very good questions. So if I start with the currency side, I think that there's definitely a case for why the dollar should be in a structural ascent at this point. I think that the key question is, however, the speed at which we see any ascent. To put it into very practical terms, as a portfolio manager, I'm here to generate superior risk-adjusted returns for you, my clients. Clearly, if I think that something like the dollar is on its way up, all else equal, I would want to be long the dollar, short everything else. But I think that's too simplistic of a calculation, and here's why. If I tell you that the dollar is going to go up tomorrow, huge leap, that's absolutely the right trade, all else equal. However, if I say that the dollar is actually going to inch up very slowly, that could very well be the bad trade, simply because whether you invest in equities, fixed income, or even currencies, there's something called carry, which we in the market consider as the return you clip over time, inherent in being long or invested in certain positions. So for me, when I look at Fed policy, when I look at the dollar, it's, again, hard for me to say structurally I want to set up the portfolios in a very dramatic way, because the speed, it's something that there's still very much a lack of clarity. Sure, tapering can happen in December, it could happen in March, it could happen later for all I know. But I think, again, the speed, it's a huge, if not at this juncture, more important determinant of how I would position the portfolio. In terms of rates, the second part of your question, if I look specifically at, I think you're saying the longer end part of the curve in the US, I think that you can look at it from a number of ways. You can look at it from fundamentals, from technicals, from valuations, and even from sentiment. And in the fixed income group, we do try to take a structured approach and break it down in those following areas. But I think what is really important is to also look at it from a risk premium point of view. You could argue something that cannot be explained by any of the stuff I just listed out. So if I go back to one of the points expressed earlier, what the Fed's done this year, it's surprised the market. The Fed, you could argue, does two things. It's forecasting the US economy, and I would argue it's done a pretty good job at making right forecasts. The other job is to communicate to market participants like us what it actually is planning to do. Rightly or wrongly, it's surprised market participants not once but twice this year, going into tapering talks in May, not tapering in September. That, in a nutshell, in my opinion, demands a sizable risk premium. And what that means simply is that if yields were X, they should be a little bit higher, X plus delta, simply because that uncertainty, it's a necessary compensation for us. So to I guess, finish that, I do think yields are going to tend to be higher. And so practically speaking, when I look at the portfolios I'm looking at, I am, at the moment, positioned a little bit underweight duration, which basically means I expect yields to go higher. But again, I think back to the bigger point I made earlier, am I going head on into some of these macro positioning? No. And the reason, again, is because the uncertainty that makes the risk-adjusted return not so appealing in the near term.
Thanks, Eric. Any more questions from the floor? Have we answered all your questions on quantitative easing? Yeah, one over there.
There are reasonable understanding on the U.S. dollar strengths against any other currencies, and also we can see any negative and positive perspectives due to the U.S. dollar strength. I have a question to Matthew about the Asian markets. We already saw the negative impact in Asian countries due to the U.S. dollar strength in the middle of this year. So what do you think about if we can see US dollar strength continuously in futures, what do you think about the negative impact in Asian countries in economies or any prices in stock or any other assets?
I'm actually going to address that in my next presentation, but my answer could very well be different to Matthew's. So I'll let Matthew go first.
Well, I think I'll just let you do it, Tim, actually. I mean, I suppose the short answer is I don't think the type of US dollar strength that we've been discussing is going to be particularly negative for Asian equity markets. I mean, ultimately, the recovery of the US economy is healthy for the world. And so that, I think, is a positive part of US dollar strength, which feeds through to all the economies and all the markets in the world ultimately. So I think the bigger drivers really of Asian equity market performance will be the fundamentals of the economies themselves, and coming back to this issue of correlations and different markets performing in different ways as we go forward, I think will become critical. There are other currency considerations to take into account as well, aside from the US dollar. So, for example, yen weakness, on the back of Abenomics, also has potential impact on markets and economies in the region, which we need to think about. One reason why the Korean market, for example, is as cheap as it is that it got sold down over the course of the last year because of the weak yen, which led people to conclude that Korea was losing its competitive position. We don't actually believe that's the case, because we believe that the majority of major Korean exporters, like the Hyundais and Samsungs of this world, are being successful not because the won is mispriced, but because they're designing and selling fantastic products globally and winning market share globally. So that's a long-winded answer. I mean, I think the short answer is I don't think US dollar strength is going to be, it's not one of the factors that's sort of in the front of my mind when I'm thinking about what to buy in the equity markets in Asia.
Any more questions before we wrap up? If there are no more questions, please
one
join.
question here.
Yes, one more.
I'd like to
Very
ask
good.
about views on gold, because gold price has been falling, and so do you think gold is still a good inflation hedge?
Gosh. What do I do with that one? James, could you...
Thank you. Really appreciate that being passed to me. No, I mean, our view on gold is certainly on a 5-10 year view pretty negative. I think gold. I joined Fidelity 2 years ago, and I said pretty much my first week, I don't get why anyone buys gold, and I was ignored by my portfolio managers for the following year, and they were right. Because it kept going up, and now it's going down and down. Fundamentally, what's gold got going for it? It is an asset that provides no income, and that is inherently speculative, because you're only buying it for its future potential price increase. You're not buying it because it has any ability to generate internal growth or to pay anything out. On that basis, I struggle to see, even at current prices, why it's an attractive investment. And moreover, if you want to hedge against inflation, I think there are a lot of ways to do it that aren't, or hedge against any risk in the economy. I think there are far better ways to do it. So no, I'd say continue to be negative on gold.
So it's negatively correlated effectively with tapering, because tapering happens because of economic strength. And if that's happening, people have confidence in the dollar, in equity markets, and everything else. Yeah. Eric, you wanted to come in?
Yeah, just really quickly. I think that there is a misconception that gold is tied specifically to one factor, in this case, inflation. I think, if anything, the last 5 years have said to me, gold is very much a proxy for your confidence in policy making around the world, particularly in the US. Ergo, if you don't have confidence in the US Fed, if you don't think that they can take us out of whatever mess we're mired in, then gold is actually a good investment. But if anything, whether it's just coincidence, what we've seen is, I think, some confidence being restored back into policymakers. And this goes back to our early question about the success of Fed's QE. And that is, in my opinion, a very important driver for why gold has seen prices fall.
Good. So we have a consistent view to end the session. Could you please join me in thanking our panelists, and I hope you enjoyed the session. Thank you.
I'd just like to thank Tim and the panel again for a very interesting session. We're now going to take a 15-minute break, so please help yourself to the snacks and drinks outside, and we'll reconvene at 10:40. Thank you.